Hello everyone, welcome to the new video of Decoding IPOs by Finance and Investment Cell of Kirori College. So today we will be decoding IPO of Prostarm Infosystems Limited. So let's move on to about the company. So when we talk about the company was established on 2008 January 11. So Prostarm Infosystems Limited is an Indian power electronics company. The company is involved in designing, manufacturing, assembling, sales, and service of energy and power conditioning equipments. So their product line includes UPS systems, lift inverters, solar hybrid inverters, lithium-ion batteries, servo control, voltage stabilizers, and isolation transformers. So critical factors such as banking, finance, and healthcare with over 16 years of industry presence of the company. They serve to these sectors, and they have an office registered in Mumbai, and they operate in 20 different Indian states. So that was about the company or the segment they operate in. So now moving on to the industry analysis. According to the products that are manufactured and assembled by the company, we look at how their market in India has evolved. So the Indian UPS market is expected to grow at a rate of 8.22%. And as company mentioned, they deal in lithium-ion batteries and hybrid inverters. So both of their markets in India, the solar hybrid inverter market in India is expected to grow by 18.60%, and the lithium-ion batteries is expected to grow by 19.67%. So these two are the trending categories in which the company operates. So that was about the company and the industry they operate in. You can see the industry analysis too. And now coming to about the IPO details. So the IPO open date was 27th May, Tuesday 2025, and the IPO would be closing on 29th May 2025, and the tentative allotment day would be 30th May 2025, and the tentative listing date would be 3rd June of 2025. Okay, so now discussing some more about the IPO. The face value is 10 per share with a issue price of 105 rupees per share, and the lot size would be of 142 shares, and the total issue sizes aggregate up to 168 crores. And the thing to notice is that all of these 168 crores would be a fresh issue, which means all the proceeds will go to the company. And the IPO would be listed at both Bombay and National Stock Exchange, and it's a book building IPO. So for the retail investors, the minimum lot size would be one, which would include 142 shares, which would amount to total of 14,910 rupees, which is a fairly affordable IPO. You can subscribe, and the maximum retail investors could have would be of 13 lots, which would include 1,800 close to shares. Okay, so that was about the IPO details and how have these 2 days IPO has been subscribed. So as you can see, the retail investors has subscribed 9.7 times, which means, and the non-institutional investors, they have subscribed 16.8 times, which shows a really high demand of the IPO between non-institutional investors and retail investors. However, the qualified institutional investors have just subscribed 0.9 times, which shows there has been a less demand than supply. And we would discuss later why qualified institutional buyers have not been putting their trust into the company. What would be the reasons behind it? So before that, let's discuss the objectives of issue. So firstly, the proceeds amount would go to the funding of working capital requirements by the company, and the expected amount is 725 million, and the repayment of all proportion of standard outstanding borrowing that has been availed by the company, which is expected. The expected amount is 179 million. Okay, and thirdly, the company aims to achieve inorganic growth by unidentified acquisitions and other strategic investments. So that was about the company, about their industry, about the IPO details, and how the IPO has been subscribed in past 2 days. So as you can see, the IPO is oversubscribed, and it's quite difficult for retail investors who would be subscribing now. They would get an allotment. As you can see, the non-institutional investors and retail investors have fairly subscribed the IPO. So now let's move to the key financials of the company, peer comparison, and our final verdict would be. Thank you. Okay, so now let's move to the key financials of the company. So in this, we would be analyzing the profit and loss statement, the cash flow, and the balance sheet of the company, and then we will be moving to the peer comparison. Okay, so wait, I guess it's a wrong slide. Wait. Okay, so the key financials, firstly, we would be looking at the profitability ratios. So, well, profitability ratios are quite good. The EBITDA margin stands at 14.2%, the net profit margin at 8.85%, and return on net worth and return on capital employed both are approximately 32%. So, it shows the good operating efficiency by the company, higher than their peers, and strong profitability from operations. And return high net worth, high return on net worth shows a great return to shareholders' equity, and it indicates that company has been effectively using their capital. Now, moving to liquidity and solvency ratios, so current ratio stands at 1.46. The ideal is greater than 1.2, which shows a good, healthy short-term liquidity of the company. And then coming to debt to equity ratio, which is quite good, 0.5. It's a reasonable low to moderate debt. The company isn't over leveraged. And debt to service coverage ratio is 5.60, which is very good. And it shows that company has strong ability to repay their loans with their earnings. Now coming to the efficiency ratio, so there's a bit of cautious in this. The inventory turnover ratio stands at 3.60, which is average moderate efficiency in managing the inventory, and the receivables turnover ratio is slightly low. It shows that slightly low connection from their debtors. However, payable turnover ratios is quite good, and the working capital days is 126 days, which means high cash conversion take times, and which should be given attention and it could be improved. So moving to the next slide, we come to the cash flow analysis. So as you can see, the cash flow from operating and investing activities are both negative, and they're negative due to high rising receivables and inventory buildup, as we discussed earlier. And from the investing activities, company has been investing heavily in buying assets and expanding their business. It's a normal, but it's a cash consumer activity. However, cash flow from financing is positive, which shows that company has raised debt and equity to support its growth and operations. So now moving to profit and loss statement, the major highlights are that revenue from operations is 5,787 lakhs, and EBITDA stands at 3,600 lakhs. The net profit at 2,200 lakhs, and EPS, both diluted and earning per share, which is so it has been improving year on year, which stands at 5.44. And as you can see in this table, which has been in the filing of the company by SEBI, so the EBITDA margin is 14.20%, net profit margin is 8.85%. The return on net worth and capital employed are both 32%, and debt to equity ratio is 0.5, as we discussed earlier. So now, moving on to the peer comparison, this is quite interesting. And as you can see, the company EBITDA margin is greater than their peers in fiscal year 2024 from Sun Garner and Servotech, which stand at 11.92% and 6.32%. Prostarm in EBITDA margin is higher. Even the net profit margin stands at 8.85% for Prostarm, and for Sun Garner it's 6%, and for Servotech it's 3%. And as you can see, the debt to equity ratio is quite similar in the industry, stands at 0.5 to zero point 0.6. And however, the days working capital is quite higher for post farm. Okay, so now moving on to the another PE comparison. As you can see, the PE ratio for Servotech is 314.55 and Sun Garner is 152. However, with the issue price of 105, the PE ratio for post farm would be 18 to 19 something, which shows that their peers are highly overvalued, and post farm is fairly valued at 18. And as you can see, earning per share is highest among the peers, 5.44, comparable to Servotech, which is quite low, 0.54, and Sun Garner Energies, which is 5.22. And even the return on net worth, and if you compare, Post Farm has a higher return on net worth compared to its peers Servotech and Sun Garner. And what could be the takeaways? Company has a higher EBITDA and net profit margin, and with return on net worth and return on capital employed, it generates higher return for investors, reasonable debt. And so yeah, as we discussed the peer comparison, that company has the highest profitability among their peers, which shows their operating efficiency, and their higher returns, which means they can generate more wealth for investors. And they have reasonable debt, which is manageable. They can pay the interest payments to their earnings. However, there's slight weakness in working capital. It has 126 working capital days, which is higher than Servotech, which means slower cash conversion. So yeah, it could be improved and given attention. And peers have extremely high P ratios. So if Postram is priced, wait, if Postram is priced reasonably, it could be of a better value for the company. Now, coming on to the final verdict and our question why institutional buyers were less subscribed comparable to non-institutional and retail investors. So it would be covered in our. So now coming to the final verdict of Postram IPO. So firstly, we can see the strong profitability matrix as we identified earlier that EBITDA margin and PAT margin were highest among its peers. Also, the return on net worth and return on capital employed indicates that efficient capital utilization had been done by the company and robust industry demand. The products in which the company deals, their sector has been growing continuously, which indicates a robust demand in the sector and a healthy financial position. Since the company has low debt to equity ratio and a good current ratio of 1.46, which provides financial stability and a strong revenue base which have been growing continuously year by year. And okay, wait. Yeah, and a diverse portfolio, product portfolio, as we see that company has been dealing with UPS systems, lithium-ion batteries, inverters, so yeah, and many more. So these caters to the critical sectors like healthcare, BFSI, and telecom, and yeah. And nationwide presence, the company has their offices in over 20 plus states and 250 plus service personnel they have. And lastly, the competition and market valuation risk. As we discussed, the competitors Servotech and Sun Garner have very high P ratios given their EPS is way less than Postram. So these companies are highly overvalued, and if there would be a correction in their stocks, then investors would surely withdraw their money from the competitors and invest in Postfarm. So that would be a major pro of this IPO. Now let's discuss some cons of this IPO. So firstly is the high client concentration risk. A large share of revenue comes from very few clients, and in which losing one could significantly hurt their finances. As you will see the revenue bifurcation of Postfarm, most of their revenue comes from government and non-government sector. And in the past year, the revenue that have been come from government projects has immensely increased, and increasing dependency on government projects might be a major con for this company as large share of revenue comes from a single client. Secondly, no long-term contracts. Business is primarily purchase-driven order with limited revenue visibility and continuity. And lastly is the operational risk. It includes risk like supply chain disruptions, cybersecurity threats, and e-waste management challenges. So these were a few pros and cons of the IPO. And now let's discuss our final word, what it would be, and let's discuss the reason why qualified institutional investors showed less interest in this IPO. So yes, you could consider investing in this IPO with caution. And based on the information that has been submitted by the company to SEBI in DRHP, the post-farm Infosystems shows a strong fundamentals, solid financials, and operates in a growing sector. And when we have to be conscious, firstly, the revenue concentration, as I already discussed, the loss of key clients can significantly impact their revenue, and no long-term contracts. The business is dependent on the repeat orders by the same clients, which add more risk. And then the peer valuation bubble. If similar stocks correct, and in the overall, if whole industry shows a correction, then post-farm may also be affected post-listing. So our final verdict would be post-farm IPO has a strong retail and non-institutional investors demand with a GMP of 27 rupees over 105 issue price, which shows a listing gains look likely, but a low QIB interest with negative cash flow and promoter concerns, as there was few articles in which there have been some cases regarding promoters. So I don't want to delve into the So yeah, so these negative effects shows caution for long-term holding. That's why QIB has a low interest in this IPO. So that would be our final wording, and thanks for watching this video, and I hope you got some educational content. Thank you.